6 beneficial tips to help you become financially smarter. Have you ever noticed how super rich people spend their wealth and think to yourself, if you had that much money, you would spend it much smarter? Yet, as we age or experience improvements in our financial circumstances, we may make decisions that our younger, less affluent selves would have criticized. It's as though over time, the financial wisdom we once held loses its relevance, or we simply forget or underestimate its significance. However, it's essential to remember that acquiring financial wisdom is never too late. Whether you've recently transitioned to a higher paying job, started earning more, or have specific financial goals you wish to accomplish, now is the perfect time to enhance your financial knowledge. Contrary to popular belief, financial intelligence isn't reserved solely for business moguls and accountants. Everyone should strive to be financially savvy because money plays a significant role in our lives, regardless of whether we desire a modest or extravagant lifestyle. So what does it mean to be financially intelligent? Financial intelligence entails understanding money, its functions, and the most effective strategies for its utilization. It involves comprehending one's personal finances and grasping some fundamental accounting concepts. In reality, however, financial intelligence can hold different meanings for different individuals. For some, it's about making wise investments and accumulating wealth, while for others, it's about practicing prudent savings for a secure retirement. Regardless of your definition of financial success, here are some universal principles that can help you to attain it. Number 1. Pinpoint the factors causing stress with your money issues. Achieving a clear understanding of your present financial situation can be challenging, especially when dealing with complicated financial issues. Unfortunately, a significant portion of the American population struggles with such concerns. According to a recent study conducted by the Global Financial Literacy Excellence Center, 60% of individuals experience anxiety when contemplating their finances, and 50% feel stressed when even discussing them. When faced with financial stress, your initial steps should include identifying the root causes of your concerns. Each person's financial challenges may vary. Some may be struggling with debt, others with uncontrolled spending habits, or perhaps a lack of budgeting skills. Recognizing these specific issues is crucial because it is only through a genuine understanding of a problem that you can begin to resolve it. Should financial pressures persist, do not hesitate to seek advice. This guidance can be obtained from various sources, including your bank's representative, a certified credit counselor, or a trusted financial advisor. An outsider's perspective can shed light on issues or opportunities you might have previously overlooked. Furthermore, engaging in discussions with a financial expert can yield potential solutions and help alleviate some of your stress. Remember, managing your finances does not have to be overwhelming. By actively addressing your financial issues, you are paving the way toward achieving your financial aspirations. Number 2. Increase your knowledge of financial issues. To enhance your financial acumen, it's essential to bolster your knowledge in budgeting, investing, savings, and debt management. Fortunately, there are numerous resources available, which can be accessed both online and offline. These resources, ranging from books and magazines to blogs and courses, offer an excellent starting point. Immersing yourself in books specifically tailored to improve your understanding in this field is a wise step. Dedicate enough time daily to reading and learning about financial intelligence, as it will enhance your proficiency in managing money. If you're unsure where to begin, 2 highly regarded books on this subject are Rich Dad Poor Dad by Robert Kiyosaki and The Psychology of Money by Morgan Housel. Magazines such as Forbes and The Economist are also valuable sources of financial wisdom and insights. However, if you have a busy schedule or don't particularly enjoy reading, there are alternatives such as audiobooks and finance-related podcasts. These options provide flexible yet informative solutions. Additionally, consider enrolling in financial literacy courses. Many financial experts have designed courses to teach essential skills, including budgeting, saving, and investing. With countless online and offline courses available, it's prudent to conduct research and select ones that align with your specific financial goals. Engaging in structured learning through these courses can significantly enhance your financial intelligence. Number 3. Be a master at managing your debt. Having bad debt or too much debt can significantly impede your financial progress. It's therefore important to address all types of debt, whether it involves credit card balances, student loans, car payments, or a combination of all. You should have a clear understanding of your outstanding debts, including their respective amounts and interest rates. Once you have a comprehensive grasp of your debt situation, it's essential to formulate an appropriate repayment strategy. One effective method is the avalanche debt repayment approach. Under this method, you initiate by paying off the debt with the highest interest rate while concurrently making minimum required payments on your other debts. Any additional funds you can allocate should be directed towards paying down the high interest debt as fast as possible. After successfully clearing the highest interest debt, proceed to tackle the next debt with the highest interest rate and continue this process. This approach ensures that over time you minimize the total interest paid. It also offers a sense of accomplishment with each debt you eliminate, serving as motivation to stay on course. Beyond managing debt, it's equally important to comprehend the various types of debt. Not all debt is detrimental. Some can be classified as good debt. Good debt pertains to loans incurred for investments that may appreciate, generate long-term income, or were obtained at a low interest rate. For instance, a 30-year mortgage on a home is often considered good debt because the property is likely to appreciate in value over time. This stands in contrast to credit card debt, which often carries high interest rates and is used for items that depreciate quickly or have a limited lifespan. Number 4, be mindful of your spending habits. Have you ever experienced the surprise of checking your bank account and discovering a significantly lower balance than expected? Or perhaps you've hesitated to open your credit card statement, uncertain about your expenses. Situations such as these can be troubling. Nevertheless, there's a method to address these challenges. Be mindful of your spending habits. Often, when individuals experience an increase in their income or find themselves with extra money, it's typical for their spending to escalate accordingly. This reaction is quite expected since additional income has a tendency to introduce a desire for things that were previously unattainable. However, as your earnings increase, it's essential to adhere to fundamental financial principles and avoid extravagant spending on non-essential items. For instance, if you've been leading a modest lifestyle on a $100,000 salary, there's no need to make drastic changes to your spending habits, even if your earnings increase to $200,000. It's always prudent to allocate your funds to things that genuinely contribute to your well-being and happiness. Be intentional with your expenses. Before making a purchase, assess its significance. Will it enhance your life? And is it even worth the price? You should know when to spend and when to be frugal. To avoid unnecessary spending, it may be a wiser decision to purchase a pre-owned car than buying a brand new one. Number 5. Prepare a budget and stay disciplined applying it. As you delve deeper into your understanding of financial literature and podcasts, it's crucial to complement this knowledge with practical actions. Budgeting plays a vital role in this process. By creating a realistic budget and consistently adhering to it, you actively take charge of your financial well-being. Budgeting isn't solely about restricting your expenditures. It serves two primary purposes. Firstly, it enables you to recognize your essential expenses, ensuring that you allocate appropriate funds to cover your basic needs without overspending. Secondly, a budget helps you track where your income is allocated. By consistently reviewing your budget, you can pinpoint and rectify areas where you may be overspending or wasting money. This not only provides clarity regarding your financial habits, but also ensures that you maintain control over your finances. To effectively budget, start by documenting your monthly income and expenses. You can use tools such as Excel spreadsheets, pen and paper, or a budgeting app. Your budget should encompass all sources of income, fixed expenses, discretionary spending, and savings goals. Number 6. Build and maintain a good credit score. Maintaining a strong credit score can prove to be financially advantageous in the long term, since it often results in reduced interest rates when borrowing money. Credit scores generally fall within a range of 280 to 850, with 850 representing the highest score and 280 the lowest. Scores typically between 700 and 749 are generally considered to be good, increasing your likelihood of securing favorable credit cards, loans, and other types of funding. Several factors contribute to the determination of your credit score, and the three major credit reporting agencies, Equifax, Experian, and TransUnion, compile and evaluate your historical credit data to generate this score. While each agency may have slight variations in their calculation methods, the typical breakdown includes 35% for payment history, 30% for amounts owed, 15% for the length of your credit history, 10% for the types of credit used, and 10% for new credit. You can obtain your credit score from any of these agencies for a nominal fee. Establishing and maintaining good credit can offer benefits beyond just saving money on interest. It also provides peace of mind, knowing you can access credit when needed. In conclusion, having a strong financial IQ impacts every financial decision you make, from how you earn, spend, save, and invest your money. Good financial management habits are crucial for achieving your financial goals at every stage of your life. Building your financial knowledge is a gradual process, and it's essential to consistently learn and adapt. By committing to understanding your finances and taking small steps, you'll be better equipped to make informed financial decisions. Well, that's it. We really appreciate you taking the time to watch these gems for success. But before you go, our team would be delighted if you could like this video and share it with your friends on social media. And if you're new here, don't forget to subscribe so you won't miss out on other engaging videos like this one. Thank you for your support.